We are waiting on these numbers. Could be a market mover on B of A. And Morgan Stanley, of course, we'll see how their capital markets business did after a blowout yesterday from Goldman Sachs. Joining me right now is independent advisor, Alliance Chief Investment Officer, Chris Zaccarelli. Chris, great to see you. Thanks for being here. First, your expectations for the earnings today.
So to your point, it's going to be really interesting to see what happens with these two banks because Goldman Sachs did so well yesterday. You know, clearly Morgan Stanley is the closest analog to Goldman Sachs in this case. And so we'll be looking to see if their capital markets can keep up. We do think it's a positive sign based on what we saw yesterday. So Morgan Stanley could do really well on the capital markets side of things. And then Bank of America, you know, clearly following in JP Morgan's footsteps. JP Morgan had good results, just not as high as the high expectations that are out there. So I think that'll really be the story. I think both banks will have good earnings. The question is, will they be good enough to beat already high expectations that have been baked into the prices coming into today?
Okay, so I'm looking at a market that has been negative now for a couple of days. Not a good second quarter, that's for sure so far. As we look at 10-year Treasury yields this morning, ahead of the Federal Reserve Chairman Jay Powell's speech later, he's going to speak today at 1:15 p.m. Eastern. The yield on the 10-year, Chris, is at 4.65%. Okay, that's up almost 5 basis points. And this morning I am reading Fundstrat, Mark Newton, Tom Lee. I think they do a great job. And Mark Newton says, overall, I cannot rule out more weakness this week, at pointing out that long-term interest rates are still pressing higher. Given that technology has not broken down relative to the S&P 500, the technicals remain in good shape, so I would buy the dips, but we're not out of this just yet. He says Monday's decline appears a bit more bearish technically and does merit addressing to explore where this might go in the weeks ahead. Now, Chris, you say the possibility of rate hikes or the more likely scenario of fewer rate cuts leave the market vulnerable to a pullback as well.
That's right. And, you know, I think the way they've categorized it is correct. I mean, I think we would be buying dips as well. We just think in the near term, there's definitely a possibility for weakness. Really, the story this year has been inflation being too sticky. You've got 3 of the last 4 headline CPIs being higher than expected and 2 of the last 3 core CPIs being higher than expected. Bond yields have moved higher, as you mentioned, and that's really got the market spooked. I don't think the Fed is going to be raising rates this year. They've had many opportunities to pivot, to say they're data dependent, to say that they're going to raise rates. You know, clearly inflation isn't coming down in a straight line the way they had hoped, but I don't think they were expecting things to be this easier. However, the idea that they're going to cut rates 6 times, that's completely off the table. The idea that they're going to cut rates 3 times, that may not be possible either. I think Fed is just going to keep rates higher for longer. That's the most likely base case. I think they want to cut rates. They've said it over and over again, but it's possible that they only cut rates 1 time this year, or maybe they have to go the whole year without cutting rates. The most likely answer from the Fed to higher than expected inflation is just to keep rates where they are, and the market wasn't completely expecting that. And as the market adjusts, both in the bond market and the stock market, that's why you're seeing weakness in both, prices down in both markets.
Well, I want to bring Mark Tepper in because Mark and I have been talking about this now for weeks. We were both shocked that the market expected 6 rate cuts, then 3 rate cuts. We're lucky if we get any rate cuts. Take a look at oil this morning, Mark, because, Mark, you got oil elevated here. Even though it's pulling back from the highs this morning, we're talking about $85 a barrel. And this on the day that China claims that its first quarter GDP grew 5.3%. Beating expectations. Mark, as you would expect, I'm not buying this 5.3% economic growth out of China, that's for sure. This comes from the CCP, these numbers.
It's tough to trust their data, obviously. But, yeah, I mean, when you look at oil, look, once oil hits $90 a barrel, that becomes very problematic for stocks. It becomes problematic for the consumer, for the economy. And typically right at about $90 a barrel, that's where you see consumer discretionary stocks begin to underperform consumer staples. So, Chris, I want to ask you this question because I'm in agreement with you that, you know, there may not even be a rate cut this year, but I do believe while there may not be a rate hike, I do believe that there will be some conversation about it. It will at least be broached in these upcoming meetings, which could spook investors. And I'm wondering, because typically in an election year, there's a 15-16% drawdown. We haven't seen much yet this year. The 200-day moving average would take us to 46.62. That's an 11.3% drawdown. We want to get more aggressive. We're looking for that meaningful pullback, and I'm wondering if it's happening right now.
Yeah, it's a great point. I mean, clearly in election years, they've been volatile in the past. Keep in mind, 2020, the pandemic was an election year. 2008, the global financial crisis was an election year. And even 2000 with the dot-com bubble was an election year. So we've seen a lot of really negative news in election years. But in general, I would say every other year you get a 10% pullback. 10% or more. And so last year, the market only pulled back around 3% at any one point in time. So that's much less than usual. We're definitely due for a pullback, at least statistically, at least looking at the averages. As far as the catalyst, could be the higher than expected inflation. Oil going higher, absolutely a problem. Not only is $90 a barrel a problem in general for businesses, but think about what that does to prices at the pump. Consumers definitely react when they see those prices changing. And it was just a few years ago, we saw prices at $4, $5 and more. You see prices of gas going back higher again, that can have a really big impact on consumer discretionary. So I think there are risks out there, absolutely, not only within the market, but to the consumer as well.
All right, going into the summer driving season, we should point out. Chris, always a pleasure. Thank you, sir. Chris Zaccarelli joining us this morning. And your morning mover, I'm going to show you United Health.